Thank you very much, and welcome everybody to Wellington's 2014 first half result conference call. As usual, I must start with the usual warning. We'll be making forward-looking statements on the call, and as these are predictive in nature, they're subject to a number of risks and uncertainties relating to Wellington, its operations, the market in which it competes, and other factors, most of which are beyond the control of Wellington. Actual results and conditions may differ materially from those expressed or implied by such forward-looking statements. I'll start off with a review of the 2014 half-year results and expand on them, and Greg will comment on the outlook for the remainder of 2014 and beyond. We'll then take questions. Greg and I can be reached after the call for any additional questions you might have, and we'll give you our cell phone numbers if you don't have those at the end of the call. The second quarter result was largely consistent with our expectations for the quarter, which was set at the quarter one update. The key features of the result are 524,000 refrigeration motors sold in the first half, compared with 655,000 for the same period last year. We sold more of our higher-priced variable speed ECR01 motor and fewer of the lower spec and lower-priced ECR8292 motor. US dollar revenue was $8.8 million, down from $12 million last year, a $3.2 million US dollar reduction. By market, Latin American revenue was down 4.4, and the rest of the world was up 1.2. Motor sales to our biggest customer group in Latin America were down 3.6. The question is, why is revenue down to our largest customer? And the answer is that there are a number of reasons. The customer's business in Argentina couldn't and can't secure approvals to import because of foreign exchange restrictions. Traditional Coke bottle cooler orders on their Mexican business are lower, largely because of the sugar tax, and they were also overstocked at the end of 2013. And there has been some loss of share to a competitor in respect of the Colombian business. Greg will comment on this in more detail after I've completed. Gross margin for the June half year was 18.5%, 16.6% for the first quarter, and 21.4% for the second quarter, and a slight improvement of what we expected. East West were ramping production in their Vietnam factory in the second quarter and supplied only 13,000 motors out of the 524,000 motors we sold in the half year. The margin improvement of the first half is a result of price reductions negotiated with our Chinese supplier. East West is now supplying 50% of our EC motor requirements, and this will give further margin improvement, especially in Q4 after our current stock levels have sold down. Operating costs were lower than for the same period last year. In the second quarter, we completed the closure of our Singapore office. The EBITDA loss increased compared to last year due to lower volumes and the pricing. Cash at 30 June was $4.9 million. Inventory levels were planned higher to reduce risk from the supplier changes we were making, and we expect to release cash from inventory in the second half year. I thought I should briefly comment also on the accounting with the preference share issue. Because the conversion ratio is not a fixed number of ordinary shares for each preference share, accounting rules require the money to be raised to be treated as debt and amortised, so that when settled by the issue of ordinary shares in 2017, the debt equates with the value of the shares given. We're also required to separately account for the embedded option, being the right to participate in share price movements above 25 cents, and to recognise fair value changes through the P&L. The effective interest rate then is not the 5% coupon, but takes into account the additional value given at time of conversion and the cost of issue. Our calculation is that the effective interest rate is 18.9%, assuming no changes in value of the option. The debt is New Zealand dollar denominated, so revaluation gains and losses will be recognised through the P&L account. At this point, I'll hand over the call to Greg to talk about progress towards 2014-2015 priorities.
Thanks, Howard, and hi everyone. I'm going to talk mostly about the revenue issues and opportunities that we are seeing in first half and ongoing, and give you a lot more colour on the customer dynamics generally. Then we'll go to Q&A and leave plenty of time for any questions you may have. I'll start with Latin America, where our year-over-year revenue for the half decreased by 47%. As Howard mentioned, this is pretty much all down to one customer in Mexico, and that customer has factories spread across the Latin American region. Demand from this customer presented and still presents quite a challenge, with that single customer being down around 4 million year over year. Howard briefly covered on the reasons, but let me give you a little bit more detail on those reasons. Of course, the sugar tax is one impact in Mexico specifically, but there are a couple of others. As the demand decreased overall in Mexico, we saw competition become a lot more aggressive, and we lost some share to a major competitor due to both price and product availability. The specific product issue was a type of motor that we didn't have to support a new beer customer opportunity. This customer is now giving us a chance to modify our motor to be able to participate in this, and we hope coming out of this year and into next year we will have that motor, it's called an ATEX motor, specific for this beer customer to now compete with that particular project. Thirdly, as Howard mentioned, customers came out of last year overstocked, and they're taking most of this year to use those stocks. One of our learnings in the first half was the brands and the OEMs have a heightened unwillingness to keep inventory in their own factories, as the visibility they are getting from the market is reducing also. I'll talk a little bit more about that later in terms of what it means to lead times. So those are the three main reasons in Mexico. We're seeing customer demand volatility in this Latin America region increasing, and several customers are now not providing forecasts at all. An interesting example of this is where our largest customer in their Brazilian business, where they actually zeroed out their forecast back in Q2 and second quarter, saying they needed no more product for the year. And then just last week, they called us and gave us an unforecasted order for 12,000 motors because their customer had dropped in demand. They needed this in a 3-week lead time. Of course, we were happy to support. We scrambled in our supply chain, and we were able to win this order on a short lead time. We think this will happen more and more with the limited visibility and the unwillingness of our customers to take stock. So that demand management process worked well, and we're able to support that short lead time order. Consequently, now we are not building to forecast either, something that we actually do in an upmarket. Now we are only building to customer order. This means when drop-in orders occur, we have to chase them, which we are doing as our customers give us those orders. We did see a couple of highlights in Latin America last quarter. We have had 2 bottlers and 1 major brand sign up for a smart controller field trial in fourth quarter. So that's really good news. And we have started selling our supermarket display case fan pack to a large display case OEM in Brazil. These are both signs that our new products will provide us with access to new customers and new streams of revenue and help diversify our business mix. So I'll move up the continent to the United States, where sales revenue decreased by 14%. Our sales partnership in this region with East West got off to a slow start in Q2, and it's fair to say that the competition we are seeing in that region from our largest US-based competitor is proving a bit more difficult than we thought. We think it will take us longer to convince new, smaller refrigeration OEM customers, which are East West's target, to buy our motors in this region. Our existing distribution partners, not East West, in the retrofit market have also decreased their volumes as government rebates for retrofits are getting smaller and harder to come by. All that said, East West has several salespeople on the street. These are salespeople that we did not have coverage before, and they have called on well over 50 customers now, many who are starting to test our product. We were actually pleased to receive our first stocking order for a large aftermarket refrigeration and ventilation wholesaler last week as a result of the East-West sales activity. And we think this is a good sign of things to come. Realistically, though, I think it'll be 2015 before we see material growth again from this region and from our new sales channel there. In addition, in the US, there are a couple of large OEMs we are in discussion with on our new ECR Mini and Smart Controller product, particularly in the supermarket display market. So we expect that to be an area where we will win new customers in 2015 once these products launch and are through customer testing and validation in first quarter. Now to Europe, Middle East and Africa, where year-over-year revenue increased by a pleasing 72%. Our largest customer in Europe has made a strong comeback this year, and in addition to the increased revenue from that customer, we are also seeing new revenue from their South Africa and Indonesia factories. Year to date, we are about $1 million higher in sales revenue with this one European customer. We are, however, seeing competitive price pressure in this customer, and it is possible going forward we will have to compete on price in order to maintain and grow with them next year. But our new cost point with East West does help us here. On the new business front, we've signed a distribution agreement with a UK distributor, and they are already ordering our ECR01 product in small quantities as they seed the market. We do expect them also to buy our supermarket fan pack product over time. In the Middle East and North Africa, Middle East/North Africa, we are engaging with a company based in Egypt who are already installing our motors in their coolers and support local soda and beer brands with our product. This relationship in Egypt has actually grown quite quickly, and we see it as a nice entry point into this region. Further south on that continent, we have engaged a sales agent in South Africa. This actually happened in third quarter, not first half. And we have already received our first quite sizable order from a large cooler OEM in South Africa. You should note that we won this order because a competitor could not meet the lead time that customer needed, and we could. We are seeing stiff competition in Europe also, but pricing does tend to be a bit better than in Latin America, and our main European competitor is not as willing so far to compete on price. Of course, that may change, so the work we are doing on the supply chain again helps us ensure we stay cost competitive. In this market, particularly, we are seeing Chinese EC motor competition become more active, and they are more willing to price aggressively into customers. In a couple of cases, in Turkey, we've had to let customer share go because of pricing. But expect once our new motors come to market next year, we can win that back. So, in summary, in the European, Middle East, and Africa region, we're seeing growth in our core customer base and new customer sales channels starting to work also. An encouraging sign. But we are aware of the competitive threat, and we're countering with our new product releases early next year. As with other regions, our new supermarket products, our ECR Mini, and our new Smart Controller products will allow us to access new customers in this region and grow revenues in this market. Finally, to Asia Pacific, another region where we have delivered growth year over year. Revenue for Asia Pacific region increased by 43%. The markets we are seeing growth in from here are actually outside of China, in Thailand, which is a large refrigeration manufacturing market, and in Taiwan, with a supermarket display manufacturer, and also in Indonesia and Australia. China is bubbling away with around 20 customers testing our motors that are a result of our new sales partnership with Ting International, and we are hopeful of seeing some of these tests approved and become revenue next year. One of the things we are learning about China is that they are in the early stages of EC motor conversion, and the majority of motors being used are still shaded pole. There are some EC users in China, existing customers of ours like Haier, albeit in small quantities. And supermarkets also use EC motors, but tend to get their cabinets from offshore manufacturers. Our plan here is to win those customers that are not converted and gain an entry point in China while we wait for conversion to accelerate. The other non-China markets are looking more attractive to us in the meantime. So we are busy signing up new sales agents and distributors in the Asia Pacific region to help expand our sales capability without adding direct sales costs. We have our partner Ting in China, and we are shipping product into Australia with a new distributor there also, and hope to expand that particular relationship into other parts of Asia because this company has a global presence. Before I move on to Q&A, I'll just comment on our new products. Our new EC motor product and our new Smart Controller have essentially completed their design phase and are now in pre-production tooling in-house validation and early supply communication so we can set up the manufacturing well. Our supplier relationships will help us launch these new products effectively, and we've already shared component lists and manufacturing methods with those suppliers so they can get started prepping their factories. The ECR Mini motor is expected to reach customers in late Q4 and early Q1 for their internal testing and fits nicely into our motor offering. We already have supermarket display case customers waiting for this product to put in their cooler testing process as a precursor to using it for their projects. On the Smart Controller, we're out in the field demonstrating our beta prototype. The product works, it connects to the cooler wirelessly, our app works, and it's getting rave reviews. We are developing further app functionality based on customer feedback. Our Smart Controller basically does what we said it would do and then some more. We have 5 firm customer trials booked for Q4 this year. Once we pass those trials, we will progress to full customer testing, which could take up to 6 months across a range of coolers and in a number of markets. That feels like a long time, I know it did to us, but that's the kind of qualification time these customers take to really make sure this technology works well with their coolers and covers all their test applications. We're very excited by the Smart Controller developments. Still a way to go to sell some, but field trials are a significant next step to get through, and that's where we're focused. Before I hand over to the operator, I just want to let you know that the team is disappointed at the revenue shortfall in first half. Really, all of our financial gaps now stem from lack of revenue. Given our supply chain cost structure work is done, it just needs to scale, and we continue to manage operating costs very well. We feel like we're doing everything we can to put in place new sales channels, develop new products, and lower our cost point to be more competitive and win. The Mexico situation's hurting us for sure, but we're not giving up on Mexico, and I think we can win some share back in that region as well as win new customers, particularly with our new products, but also with our existing products. Sales activity and new customer wins in other regions look okay, and I personally can't wait to get our new products in the market at the end of this year to accelerate further. So that ends my comments, and operator, back to you to go to Q&A. Thank you.
Thank you. To queue for a question, please press star 1 on your telephone keypad and wait for your name to be announced. We'll pause a moment to assemble a queue. Your first question comes from the line of John McMahon from Arrow Investment Management. Your line is open. Please go ahead.
Morning all. Greg, you talked about getting the gross margin up to 25%, reiterating that. How much of that is dependent on getting some volume recovery, or is most of that locked in just kind of on the run rate that you've got annualizing through at the moment?
Yeah, good question, John. Thanks. The cost point that we've got agreed with East West and the pricing we've got agreed with our Chinese supplier pretty much locks that in. Now, there's always product mix that goes into gross margin as well. I think it was an interesting sign in first half that we sold more of our higher priced ECR01 motors than the lower priced motors. I'm not sure that's a trend yet, but it's we certainly are seeing more customers take that motor. So on the supply chain cost point of view, it's we have the cost point we need. We just need to scale revenue through that cost point. So I think we're pretty comfortable, actually very comfortable, I'd say, with that 25% gross margin next year, certainly. And if we see the revenue come back in fourth quarter this year, maybe then as well, but certainly next year.
Okay. And do you think competitors can continue to cut pricing in the likes of Latin America, or do you think that's a race that's largely run now? I hesitate to ask you to make a call like that, but your view would be valued.
I think the view we have is our Western competitors, one in Europe. The one in Europe is interesting. I mean, the fractional horsepower motor commercial refrigeration business for them is not a large business. It's a very small part of their portfolio. They don't tend to be as aggressive on price. That may change. We'll see. The US-based competitor, we certainly seem to be able to compete head for head around about the same price level with them. I think they've got a similar cost structure to us. But again, this business is quite small for them. There's one Chinese competitor that in a couple of customers has gone much lower than the rest of the market. We're not sure whether that's buying the business or whether it's, they have a fundamentally different cost structure. So my view is those Western competitors, we're about the same, and there isn't that much more to go in the current technology to take costs down. It's not always easy to see behind these, particularly the private companies, and what their cost structure is. So I guess it's fair to say I'm a bit worried about that Chinese competitor, but time will tell, actually. And we haven't really lost a lot of share to the Chinese competitor. One customer in Turkey, as I mentioned. If they were out there making similar bids to 10 or 15 customers, I'd be more worried, but they're not yet.
Okay, thanks. I'll hop off. I've got a few more questions. I'll jump back in the queue if others don't cover them.
Thanks, John.
Your next question comes from the line of Roger Armstrong from Aspiring Asset Management. Your line is open. Please go ahead.
Hi, Greg.
Hi,
with the decrease in revenue you've experienced in Q1, I would have expected you to perhaps, Q1 and Q2, I would have expected you to perhaps panic a bit earlier and a bit harder. And in particular, I'm seeing your employee benefit line going up 6%. I don't know whether there's any currency issues in this, but I would have thought that you would have been cutting your employee benefits, and you may have made some symbolic gestures around cutting your number of board members too, but I haven't seen anything. Can you comment on this?
Thanks. Yeah, no, good question. Let me let you know what we have done, and maybe Howard, you could comment on the 6%, just where that comes through. So, we've seen the sales line certainly in Latin America, and I think telegraphed right at the beginning of this year that we were worried about that. This year, we haven't really added any headcount other than, I guess we've been signing up sales agents, unless it was a sales resource that was going to go to adding revenue or a specific engineer, and I think we've only added one or two this year that have been directly related to getting our new products out, software and hardware engineers. So, in our operating structure, the majority of our team is sales and engineering. We did have a lot of our staff focused on the supply chain transition in first half, and I just felt like it would have been a mistake to start looking to rationalize that team, because right as far back as last year, I've said I didn't want to fail on that supply chain transition. It really was our future cost point, so I didn't want to skimp on that. So we did throw some cost at that, particularly East-West. The East-West, we had people on planes, kind of making sure those factories came up to speed. We also brought online a new supplier in Indonesia. We shut down our Chinese electronics manufacturer and moved it all to Indonesia, our lowest cost point. So we did spend some money. I think money well spent to make sure the supply chain transition went well, and it's gone very well so far. We're under target this year on cost. I think we're doing a really good job on operating costs. Without actually impacting our ability to win customers or develop products, I don't think there's a lot much room in terms of the operating cost structure, Roger. I take your point on the board and kind of benefits. In terms of any kind of board changes, that's something I know Tony as the chair is always evaluating. I'd be happy to pass those comments on to him. I think that's where we are, Roger. We're not sitting here not looking at costs. We look at it every day. Discretionary spend is something we stand on. I haven't been doing trade shows this year on purpose because they're too expensive. We can't afford it. We've just been trying to focus all of our cost on customer value add, new products, and winning customers. That's it.
Right. And
Howard, what about the 6%? Sorry, Roger, the 6%, Howard. Do you have I don't recognise that number. That's probably coming from the accounts. So
you were incorrect, Greg, in terms of we haven't added much headcount in the first half, but we did add headcount in the second half of last year, largely to expand in the market. For example, into Asia, but also to beef up the development team to get the products out. So comparing H1 2014 with H1 2013, there is incremental cost through headcount, and it was all directed towards the sales activities and engineering development activities.
Right. So, Greg, with your market tanking and some of your traditional products and your traditional markets, you're obviously relying on some of your new product releases, and some of which are iterations and some which are new products, to really come to the rescue of this company. But when you talk, everything seems to be sort of 9 to 12 months away before anything happens. I mean, I know things take time, but is there anything that can be done to accelerate the revenue on this, perhaps through upfront payments from people who commit into relationships with you, or anything? Is there anything that can be done in that regard to try to accelerate the revenue you get from new products?
There's one thing we're already doing, Roger, and so let me comment on what we're already doing with existing products. One of the main reasons we're out there signing distribution agreements is to try and accelerate revenue. So we've done a distribution deal in Australia right now, and that particular distributor's got coverage throughout Asia. I mean, they've already booked $200,000 worth of revenue just in first half, just by going out and giving us more sales coverage. That's sales we would not have got otherwise. Likewise, in the UK, we've already seen, I think that's more tens of thousands in orders, but we're hoping that will scale. The sales agents and distribution agreements, the East-West one is taking longer. It's in a mature market. That's where we can accelerate sales of existing products in mature and immature markets, like the South Africa opportunity we won was as a direct result of a relationship we formed with a sales agent in that market. So these are all opportunities we would not have won because we just wouldn't have been able to afford or have the scope to go into these markets with direct sales. So we're doing that. We're going to continue to do that. So that's one, that's something where I think is a positive. So that's on existing products. It is fair to say, though, Roger, those existing products, one of them in particular, the 8292, the lower cost product, is an older product. It seems to be selling less. The ECR01 is selling more. And so we do need those new products to come to market, the new motor and the new controller. The new motor is focused on supermarkets. The controller is both supermarkets and bottle coolers. I think we are a bit at the mercy of the customer qualification times in this. It's interesting in this space. Customers seem to take a long, long time to get products through their own internal approvals. The field trials we're doing in Q4 are the first hurdle we have to overcome, and actually the major hurdle. We think after those field trials are done, there's still, depending on the brand, so our biggest brand, the Red brand, has a very intricate, sophisticated, and long qualification process for new technology. The other brands of the other colours aren't so long, so we think we can sell some of those new products into that brand certainly by second quarter. We would have in our outlook for next year, we'll be selling some of those controller products. The motor will just fit right into our existing portfolio. Customers can just move from our existing motors where they need to our current motor. But there's still 3 months, and some customers 6 months of qual time. They really make sure they haven't got issues with new technology. So I don't know, there's a lot to do that we can break those qualification processes, but we are targeting customers, Roger, where they are shorter to get to market first. So that's kind of where we go with that.
Yep. Okay, thank you for that.
Your next question is a follow-up question from John McMahon from Arrow Investment Management. Your line is open. Please go ahead.
Hi, guys. Just a few more. Can you comment on how much excess inventory you were holding at the end of the first half? What you think the normalised number would be?
I think it's probably around $2 million US was too much.
Okay. And I noticed capitalised development time jumped considerably, which looked that was obviously on a year-on-year basis. Looking at your accounts for last year, it was obviously quite high in the second half as well. Presumably that's just related to the EC motor and the smart controller development, and that will progressively start winding down from this point.
That is correct in respect of the cost last year and this year. Obviously, we've got other products that we have identified are gaps in the portfolio that we'd like to develop, but at this stage, all the efforts are on finishing those two products.
Okay, and just on the sales, on your revenue table, on the report that you released, you can obviously see the price pressure that came through in Latin America. But if I look at the Europe, Middle East, and Africa markets, where you had motors up 90%, but revenue up 72%, is that indicative of greater price pressures in that market as well, or are you seeing a bit of mixed change also?
I think in Europe specifically, not Middle East and Africa, we're seeing some mixed change, John. We did offer some price incentives to our largest customer in Europe coming out of last year. I think those came into play in the first half. That was to win this year's business. We haven't given away any further pricing to that customer this year beyond that. So it was mainly product mix, and then our largest customer, which weights that, we had pricing flowing from last year. In Middle East and Africa, those are nascent markets for us, and we're actually seeing pricing to be pretty good in those new markets. So hopefully that lasts that way. There's a different competitive structure in the Middle East and Africa, which we're thinking works in our favour.
Okay. Look, lastly from me, just going back to the annual meeting, I think there were a couple of things either mentioned or demoed there. One was you talked about getting back into the ventilation market via sort of relatively low-cost options with existing technology. And secondly, I think you showed up, it was a C-frame motor, which looked like it was a bit of a skunkworks project. Can you comment on developments and kind of the outlook or any timing and whether both of those are likely to be going ahead or not?
Yeah, I can. Good question, actually. I purposely didn't put them in the update because, I guess they're both what we call, well, certainly the C-frame is what you say is a skunk work. And what I tasked, just to let you know, I tasked the engineering team a year ago to not compromise our existing two core products. And in their spare time, I mean, this is kind of what some big tech companies do in the States. They take time out after hours, they're working weekends, they're working, late at night to bring our next new products into a concept stage. So we've actually got the C-frame product working on a bench. It looks like it could be a viable product. We haven't capitalised any of the input into that yet. It's been a very small expense to get it there. It's all brown dollars, as they say, not kind of new dollars. We're not spending tooling on it. We're not doing anything like that. And what we hope to do on that C-frame, we've kind of, it's being bumped back a little bit because we're desperate to get the two core products, Control and ECR Mini, to market. But we'd like to get some concepts out to customers of the C-frame in Q4 this year so they can give us feedback and let us know whether they will buy that product and put it in their coolers, in which case, we'll look to get some commitment from the market and make that a more formal project. There's a heck of a lot of C-frames with our customers. One customer alone in Turkey uses kind of 300,000 of these things a year in coolers, and they've indicated to us that they'd be looking for a new supplier if our product works. So that could be quite attractive. So I think if you were asking me now, I'd bet that the C-frame could become a product, but I don't want to kind of jump the gun on that until I've got customer commitment, customer feedback later this year. On the ventilation front, we're being super cautious on that. It's something we're doing with East West. They have a number of customers, so they own the market, and the customers in that case that have expressed a desire to have an electronic motor in some of their ventilation products. East West has sourced a motor from their supply chain in Asia, and we have taken one of our existing electronic designs and integrated into that motor. So again, I'd call it a very early concept to see if we can make it work. We intend to take that concept to the East-West customer with East-West and see if we can get a commitment to buy. And if we can, and it can be connected to revenue, then we'll probably look for East-West to help kind of fund that into a product. So those are both early in the production cycle and the design cycle, John, but I'm probably more bullish on the C-frame than the ventilation. I'm just because we're not as close to the customer on the ventilation. We're having a lot of conversations, making sure we get it right with East-West.
Okay, thanks.
Once again, to queue for a question, please press star 1 on your telephone keypad. There appears to be no questions at this time. Mr. Milner, please continue.
Greg, do you want to continue? Close it out?
I can finish off. So I just want to make sure you know Howard and I are available after the call if you'd like any one-to-one discussions. My cell phone here in Canada is +1 778 238 6494. And Howard, yours in New Zealand?
Is 027 5870 455.
Thanks everyone for listening, and you can be assured we're all really, really focused on this revenue situation in Latin America, but also, continuing to build on the strength we saw in the other regions, which we're quite excited about. And lastly, these smart controller field trials, it's super pleasing to get those booked so early, and we've got to execute those, which we will do, because straight after that we move into a revenue phase with some of those customers. So those are critical. So I'll be updating you about how we get on with those field trials in fourth quarter. Thanks everyone. Have a good day.
That does conclude our conference for today. Thank you for participating. You may all disconnect.